Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies and study how they actually think, line by line. Today we're looking at an expert advisor for MetaTrader 5 called Arnaud Legoux Trend Reclaim. It's built around the Arnaud Legoux Moving Average, a smooth but low-lag trend line, and it uses a trend-following, pullback continuation style. By the end of this video, you'll understand how it defines a trend, how it waits for a dip back into that trend, and how it manages its risk. Remember, this is educational content only, not financial advice. Let's start with the big picture. Arnaud Legoux Trend Reclaim is a trend-following system, and more specifically, a pullback continuation system. That means it isn't trying to catch tops and bottoms, and it isn't chasing brand new breakouts. Instead, it waits for a market that is already trending, lets price pull back a little, and then looks to join that trend once the pullback has been reclaimed. The engine behind it is the Arnaud Legoux Moving Average, often shortened to ALMA. This is a Gaussian-weighted average with a phase offset. In plain language, it lays a bell-shaped curve of weights across its window and slides the peak of that curve toward the newest bars. The result is a line that stays smooth, like a longer average, but reacts faster and lags less. The strategy uses two of these ALMAs that share the same offset and width, but use different window lengths. The short window becomes a fast, low-lag price tracker. The long window becomes the trend spine, a stable baseline that represents the underlying direction. The approach is designed with a genuine trend filter rather than just checking whether a line points up or down. It measures how far the spine has traveled over a set number of bars and compares that distance to recent volatility using the average true range. Only when the move is meaningful relative to volatility does the strategy consider the market to be trending. That keeps it out of flat, choppy conditions where reclaimed signals tend to whipsaw. In terms of who this style suits, it's aimed at traders who are studying systematic, rules-based trend following on liquid instruments. The notes in the code suggest a trending foreign exchange major or a metal, such as Eurist or ZOST, on the 1-hour to 4-hour timeframes, though it reads every bar from whatever timeframe the test is run on. As always, trading involves risk, losses do happen, and nothing here is a promise of any particular outcome. This is a study of how the logic works, nothing more. Now let's walk through the exact logic. The strategy acts once per newly closed bar, so every decision is made on completed data, never on a half-formed candle. On each new bar, it first checks whether a position is already open under its own magic number. If one is, it stands aside and lets the existing stop and target manage that trade, one position at a time. Next, it builds its two averages. The fast ALMA, with a default window of 9, hugs price closely. The slow ALMA, with a default window of 30, is the smoother spine. Both use the same offset of 0.85 and the same width, or sigma, of 6. Then comes the trend gate. The strategy measures how far the spine has moved over the last 5 bars. That's the slope bars setting, and compares that travel to the average true range multiplied by MinSlopeAtr, which defaults to 0.3. If the spine has climbed by at least that much, the regime is considered an uptrend. If it has fallen by at least that much, it's a downtrend. If neither is true, the market is treated as too flat, and the strategy simply waits. With a valid trend confirmed, it looks for the reclaim. For a long, 3 things must line up. The spine must be rising. On the prior bar, the fast ALMA must have slipped down to or below the spine, which represents price pulling back into the trend. And on the just closed bar, the fast ALMA must cross back above the spine, while the bar's closing price finishes above the spine as well. When all 3 agree, the pullback has been reclaimed in the direction of the trend, and the EA signals a long entry. The short side is the mirror image. The spine must be falling, the fast line must have popped up to or above the spine, and then it must cross back below the spine with a close underneath it. That signals a short entry. Risk is scaled to volatility on every trade. For a long, the stop loss is placed below the entry by AtrStopMult ATR, which defaults to 1.8. The take profit is then set at RewardRatio times that stop distance, defaulting to 2. So the target sits twice as far away as the risk. For a short, those distances are simply flipped to the other side. From there, the ATR stop and target manage the exit on their own. Let's read the MetaEditor code on screen. At the top are the inputs. FastWindow and SlowWindow set the two ALMA lengths, 9 and 30 by default. Offset and sigma shape the average, controlling how responsive and how smooth it is. Slope bars and MinSlopeAtr define the trend gate. ATR period, ATR stop multiple, and reward ratio govern the risk model, and lots and magic handle order size and identity. Now the long block. The condition reads, if up and reclaim up, and the signal close is greater than slow now. In words, the trend must be up, the fast line must have reclaimed above the spine on this bar, and the closing price must be above the spine. When that's true, the entry is taken at the ask. The stop loss is the entry minus ATR stop multiple times ATR. The code confirms the risk is positive, then sets the take profit as the entry plus reward ratio times that risk. Finally, trade.by sends the order with the stop and target attached. The short block is the mirror. If down and reclaim down, and the signal close is below slow now, the entry is taken at the bid. Here the stop loss sits above the entry by the same ATR multiple. The risk is measured as stop minus entry, and the take profit is placed the reward multiple below entry. Then trade.sell sends it. Notice both sides return immediately after ordering, so only one signal acts per bar. Same structure, opposite direction. Let's bring the logic to life on this chart. You can see two lines drawn over the candles. The gold line is the fast Arnaud Legoux Moving Average, our low-lag price tracker. The blue line is the slow ALMA, the trend spine that represents the underlying direction. Watch how the two interact, because that relationship is the whole strategy. On the opening candles, price is stepping higher, and the blue spine is sloping steadily upward. That rising slope is important. The strategy measures how far the spine has traveled over the last 5 bars and compares it to volatility using the average true range. Because the spine has climbed by more than its 0.3 ATR threshold, the market qualifies as a genuine uptrend, and the strategy is now allowed to look for long setups. Notice the gold fast line is riding comfortably above the blue spine here, confirming momentum is with the buyers. Then the mood cools. On the next couple of candles, price pulls back, and the gold fast line dips down to touch and slip beneath the blue spine. This is exactly the pullback the strategy is waiting for. It is not a reversal signal. It is price catching its breath inside an ongoing uptrend, and the fast line pressing into the spine is the sign that the dip has arrived. Now watch the reclaim. On the buy entry candle, the gold fast line curls back up and crosses above the blue spine, and this candle closes above the spine as well. All three conditions agree. The trend is up, the fast line has reclaimed the spine, and the close confirms above it, so the EA signals along. That's the buy entry marker. The stop is placed below, at 1.8 times ATR beneath entry, sitting under the pullback low, and the take profit is set at twice that distance for a 2-to-1 reward to risk target. Over the following candles, price accelerates upward in the direction of the trend and reaches the take profit target. The continuation played out, and the trade closes at its objective. Now the picture flips. After the peak, price rolls over and begins stepping lower. The blue spine bends down and starts sloping negative, and the gold fast line drops below it. Once the spine has fallen by more than its ATR threshold over 5 bars, the strategy recognizes a downtrend and begins hunting short setups instead. Watch the mirror image unfold. On the pullback candle, price ticks back up and the gold fast line pops up to touch the blue spine from below. That's the rally into the trend. Then, on the sell entry candle, the gold line crosses back beneath the spine and the candle closes below it. The falling spine, the reclaim below, and the confirming close all line up, so the EA signals a short. That's the sell entry marker. This time the stop sits above entry by the same ATR multiple, and the take profit is placed twice that distance below. Price then slides lower into fresh lows and reaches the take profit target. Same reclaim logic, simply in reverse. 2 trades, one rising and one falling. Both built on the fast line reclaiming the spine in the direction the trend was already traveling. So that's Arnaud Legoux Trend Reclaim from top to bottom. We saw how it builds a fast tracker and a slow spine from the Arnaud Legoux Moving Average, how it gates entries with a volatility-scaled trend filter, how it waits for a pullback to be reclaimed in the direction of the trend, and how it manages every trade with an ATR-based stop and a reward ratio target. Remember, everything here is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Markets carry real risk, and losses are a normal part of trading. If you found this breakdown useful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.